And I think that's because, why does this matter? I think that's because there are shortages on the COMEX and LBMA. We've seen that. And China's not letting gold get out. You saw Russia nationalize their third largest gold mine. And there's been scuttlebutt I put on Twitter that sources have told me that have been reliable on other previous Russia predictions that feel as though Russia is angling towards maybe a bigger nationalization of its gold market. And I think the BRICS countries are coalescing around gold as one of their key assets to support not only their currencies and potentially a joint currency that they're talking BRICS currency that they've been, mouthing off about for a while, but have to put infrastructure first. Now, if we get a huge breakout in August, September, gloves are off, and maybe we have a run, and we'll have to look at what the catalysts are.
Robert Kientz, founder of Gold Silver Pros and author of Drop Shadow, has issued a stark warning about the accelerating efforts by major Eastern powers to elevate gold's status in global finance. He points to Russia's recent nationalization of a significant gold mine as a signal that Moscow is moving decisively to control its domestic bullion production, reduce reliance on Western financial systems, and insulate itself from sanctions and dollar volatility. China, meanwhile, is expanding its gold reserves at a historic pace, with figures from Trade Data Monitor, sourced from China's Customs Office, showing that gold and silver imports surged by 80% in the first half of 2025 compared to the same period a year prior, reaching a cumulative value of $1 billion. Kientz contends that gold is set to become a critical pillar in the future of sovereign currency systems, particularly among the BRICS bloc, Brazil, Russia, India, China, and South Africa, as these nations seek to build a more independent and asset-backed monetary framework. However, he notes that implementing a unified gold-backed currency would require enormous cross-border coordination, standardized pricing mechanisms, and a new institutional infrastructure capable of settling large-scale trade flows in physical assets. That process is already underway. China, for instance, has established its first offshore gold vault in Hong Kong, directly connected to the Shanghai Gold Exchange. This facility enables international trade partners to exchange surplus yuan for gold, bypassing the US dollar entirely and advancing China's long-term strategy of de-dollarization. According to Kientz, these moves are more than tactical maneuvers. They are indicative of a sweeping generational realignment in the global economic order. As Western currencies, especially the dollar, face growing skepticism due to monetary expansion, inflation, and sovereign debt risks, BRICS and other emerging economies are preparing to fill the vacuum with alternatives rooted in tangible value. Kientz warns that the transition could be turbulent, with increased volatility in currency markets, disruption in global supply chains, and a redefinition of capital flows. While governments and central banks may attempt to manage the fallout, he cautions that individuals and private investors must take responsibility for their financial resilience. Now, we present the clips from Kientz's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
For gold, there's about a 18-month period of time between February of last year and about this middle of this summer where gold just ran. I think I mentioned last time on the program that the summer tends to be a little bit weaker for the metals markets and even sometimes the financial markets, but especially metals markets because they don't get the money pumping by the Fed like the stock market does.
Right.
So what you'll typically see consolidation patterns, usually sometime in August. We talked about this last time. Thank you for the chart. August, a lot of times you'll have breakouts, not every year, but sometimes, and I'm just talking about a short-term breakout, not it's going to 50,000, all that kind of thing. And so, but we've had the gold breakout and it needed to rest, and it was predictable that during the summer it was going to rest a bit. People rest their positions, they reposition, and we haven't had that global meltdown sort of catalyst to kind of break it. What we do have coming forward is going to be the love trade with India and China and them using gold in their ceremonial. The other thing I'd like to point out is that China is now going to Africa, going to the artisanal mines, and there are legitimate artisanal mines, and then there are the slave labor mines. And I'm not going to separate the two here because there are legitimate artisanal mines all over the world, including South America. In fact, this is the way it used to be done in the US with Wild Wild West, right? And in Canada. Not everything can be done by a big company because the deposit may not be there or the country may not have the infrastructure. So the gold market in Central and South America does have big companies, but it also has a lot of independent, and some of that's legitimate. And anyway, the Chinese are kind of coming after that. The U.S. is too, and so is the U.K. There are forces in the U.K. that had contacted me a couple of years ago that were interested in maybe setting up an ETF, and could I help them connect them to the arsenal mines? And I don't really have those connections in that part of the world, so I told them I couldn't. And honestly, I didn't want to put it into an ETF. I want the gold to come out physically for people. So I didn't participate in that. But everybody's going after these arsenal mines. And I think that's because, why does this matter? I think that's because there are shortages on the COMEX and LBMA. We've seen that. And China's not letting gold get out. You saw Russia nationalize their third largest gold mine. And there's been scuttlebutt I put on Twitter that sources have told me that have been reliable on other previous Russia predictions that feel as though Russia is angling towards maybe a bigger nationalization of its gold market. And I think the BRICS countries are coalescing around gold as one of their key assets to support not only their currencies and potentially a joint currency that they're talking, BRICS currency that they've been mouthing off about for a while, but have to put infrastructure first. And so people are impatient. Why hasn't it come out yet? Well, it'll come. You got to build, a whole system around that. We're talking about 50 countries with different regulatory regimes. That will eventually come. So I think that's kind of where gold's going. But right now, that's kind of the 2 to 5 year picture. And right now, gold's just kind of sitting there consolidating, waiting for a catalyst. And I warned people a few months ago this would happen. But I expect in the fall it'll have its normal upward movement. Now, if we get a huge breakout in August, September, gloves are off, and maybe we have a run, and we'll have to look at what the catalysts are. I don't necessarily expect that. But we'll see what happens with like geopolitical things and stuff like bank failure, stuff like that. They basically bailed them out internally with their state-owned enterprises and kind of kept it afloat. And if you go back to look at currency printing, I did this really good study in 2010 on Seeking Alpha, where I looked at money printing across different nations. I looked at 6 major measures of the economy, like M2 and inflation and all that kind of stuff. But when you looked at the currency chart, China had printed more up to that point than the US had, even with all the printing we did through the Great Recession. China's been printing currency like mad. They're having their own issues. And they're trying to stabilize it by, that's why China, Russia, and them are hoarding gold. They know the crash is coming, and they're doing the right thing and telling their citizens to hoard gold. They're hoarding gold because they know the reset's coming. So they're preparing, but they need more time to prepare to stabilize. And for the Chinese people and the Russian people, of course, I don't want them to suffer. We definitely want them time to prepare. But China's printed excessively. China's trying to switch over from an exporting country to building up their own middle class to where they can self-support. So they're on the US path, but they're early on. And so they're going to have a lot of growing pains along the way as they go there. It's not a smooth path. The US, it wasn't a smooth path either. We had our issues before, we had our strong currency era. But as the US rotates out of being the dominant currency and it rotates into being probably China, we think will be the next one. That takes time to happen. China's not ready yet. And so they've got to clean out a bunch of crap from their system and revalue. So when the currency revaluation comes, it's going to come across the world. And it's going to clean out a lot of the debt issues, a lot of the trade issues, and you're going to see a rebalancing of global trade, a rebalancing of currency valuations. You're going to see gold become very prominent in supporting this worldwide currency system. And that's kind of where we are. It's kind of this generational change in just the way that trade and currency systems work. And the world participated in the dollar, and the world is going to suffer when the dollar collapses. And it's not just going to be a currency failure. We're going to have failures in trade, markets, things like that. It's not going to be isolated to the United States. And typically, other countries' currencies crash before the dominant currency. So the US may be the last horse in the glue factory, but it ain't going to last either. And so you're seeing issues in Turkey. And by the way, Turkey's implementing capital controls as a result. You've seen issues in Argentina, but Malaya's been down there trying to stabilize. You're seeing issues in Russia and China, and they're trying to stabilize. So the governments of the world are trying to get a grip on it. But it's all that dollar inflation that's affecting the rest of the world and causing problems there. And that, by the way, is one of the major reasons why the world is now aligning outside the US and the dollar. Okay, so that's really kind of the 10,000 foot view of historically how these things have gone, kind of bringing it current to what we're seeing now. And so that kind of explains what's going on. Yeah, China will have a crash. But with all the gold that they have and with all the ports are opening around the world, the Brick and Road Initiative, I think that they're going to recover much quicker than the United States. The United States crash, the big one will probably come after, and the United States is going to have to figure out what its strategy is going to be because we don't have the manufacturing base. We don't necessarily have all the things that some of these other countries have been working on. There's questions about how much gold we have in Fort Knox and underneath the New York Fed and all that kind of stuff. So Trump's trying to do some things around the sovereign wealth fund. By the way, other countries have had sovereign wealth funds for a long time, but that's going to be a drop in the bucket. It's not going to handle the $37 trillion in debt. So that's why when you look at China and Argentina and Turkey and all these countries are having issues, Greece is a good one, Spain, you know, all that kind of stuff. Brazil, Venezuela, right? That is what is going to happen to the U.S. So when you watch that, that tells you what's coming, and it gives you a bit of time to prepare. And I'm telling you right now, the government's not going to save you. They can't.
In a development that signals deep structural shifts in the gold market, more than 2 million ounces of gold have already been physically delivered through COMEX in 2025, surpassing every annual total for the past 15 years. According to Robert Kientz, this level of physical settlement is highly unusual for a market historically dominated by paper contracts. What's even more significant is who's driving the demand. It's not retail investors, but rather industrial and institutional buyers stepping in with force. Since early 2023, the trend has been building, with a steady rise in physical deliveries suggesting that large-scale players are increasingly opting for real metal over derivative exposure. This shift is redefining how analysts interpret price action in the futures market and is reshaping investor strategies. Simultaneously, China's appetite for gold continues to swell. Vaulted holdings at the Shanghai Gold Exchange have soared to a record 35.74 tons, an 18% increase in just 1 week and a staggering 136% jump since the beginning of the year. Kientz points to this surge in industrial accumulation as a historically reliable signal. Institutional demand typically precedes retail flows by 6 to 18 months. This pattern suggests the broader public has yet to respond to underlying shifts in the market. As institutional buyers move early, positioning themselves ahead of potential monetary or geopolitical inflection points, the current surge in physical gold movement may represent a quiet but powerful recalibration of trust away from fiat instruments toward tangible assets.
Yeah, and the U.S. retail is very cyclical, more so than other nations in which have thousands of years of history of gold. We had it for a while, and then we went to the dollar. So really, most of our country has been dominated by like greenbacks or dollars or what have you. And gold was part of our system, but it's not a 5,000-year history of like you're going to get in Egypt or China or something like that. So that's why you see the BRICS nations going back to the long-term view on gold as the asset of last resort and also as the best buttress for your currency and trade systems. The United States is much, much younger, doesn't have that sort of view. So a lot of the people, it's been a few generations since 1971, since anybody really had gold as backing of the dollar. And it was back to 1933 with the Confiscation Act, where we actually circulated gold as a currency alongside any of these other transitory paper currencies. So you have to understand it's been about 100 years since gold's really been a part. So that's about 4 or 5 generations. People really haven't had it as a part of their everyday commercial ventures, gold or silver. And so the charts look like in the US, it's a very simple to understand when we have a recession. Gold goes up, silver goes up. No recession, it fades down. Recession oncoming, gold, silver goes up. And the prices will go up before retail will engage in buying the metals. And so the Eagles is a very good sort of microcosm of that. It's not the whole market, but it's a very good indication of diehard Americans that like American gold and silver Eagles as the #1 sovereign coin in the US. And when you see those start to creep up and stay creeping up, you know that retail's in it. But the commercials always get in first, hence the rising prices on the commercial markets, the delay until the retail markets catch up. And when you start to see real public signs of recession, bank failure, stuff like that, there'll be a period of time in which gold and silver will start to rise, and then you'll have the panic run. So we're just not quite there yet. I would say I kind of expected the currency to really start to hit the skids, but with the stablecoin stance by the government and trying to move the treasury trade over to stablecoins and get all the digital guys to go into it, I think they bought the dollar a little bit at a time, which is a good thing, because if you have not prepared by having gold and silver portfolio, guess what? You get a little bit longer. That's a good thing. People are like, crash it now. And I'm like, do you understand what that's going to do to people? More time is always a good thing. It gives us an opportunity, one, to fix our trade issues, to put some solutions in the economy, and to get people into gold and silver to help protect them. If the whole thing crashed right now, you'd have a lot of American families suffering very, very badly. And that's not what we want. So I don't care that my prediction wasn't exactly on point. I like the fact that we have more time because it helps people. So I'll take that. I'll take a few years delay in that so that people can prepare. I will tell you that even though the U.S. government is doing like Bitcoin and gold in their sovereign wealth fund, I do not suspect that that's just going to be distributed via food lines and things like that during the next recession. I think they're going to use it to stabilize the system, which is a good thing. But that means that you, because of our debt levels, which by the way, we are legally tied to, every person that is a citizen in America is by law tied to our debt. We owe it. And so we don't want it to crash right now. We want to get people more stable with some gold and silver, in their portfolios, so that when that crashes, they have alternatives and options. And I think that's extremely important.
Yeah, I'm pulling up the CME chart here based on the deliveries.
I think we're, especially if you look at Elliott wave analysis, we're not quite to the last fifth wave. I'm not an Elliott wave expert. I follow other people that are. Abby Gilbert is a really good one. You can follow him on Seeking Alpha. When you have a true long-term pattern that you can graph out into the Elliott wave, basically that shows you the last wave is kind of the big one, and it takes some time to get there. And you can see us moving to that point, but we haven't had the super big breakout. Now people are going to say, well, Rob, gold's 3,400. How can I afford an ounce? Well, you've got fractional gold. You got things like gold backs, which are like 1/1000th of an ounce you can get for $8-10. My company Kientz has their version of that as well. Not trying to plug it, just giving you options. There are ways to get fractional gold, so you can have a little. You can even get gram bars from Valcambi, from a host of providers. If anybody's interested, contact me privately and I'll get you hooked up. I don't want the money. I'll just educate you on your options. Also, gold is often said to be the money of kings, silver of gentlemen. So if you can't afford gold, you can always do silver as an alternative. Silver always follows gold, so it actually gives you more time. But then when silver pops, it goes real fast. So if you're going to do silver, it's now, don't wait. If you can't afford gold. But I would always recommend, and I'm not a financial advisor, always my disclaimer, check with your financial advisor, do your own research. But if you've decided to get into gold and silver, what I do is put that way. I do a lot of fractional gold. I don't do 1 ounces because it's going to be so expensive. You're not going to be able to trade it for bread. You're going to be buying city blocks, right? That's the history of when we revalue economic systems on gold. It becomes extremely powerful. So you don't need a lot. So buying fractional gram bars, gold backs, other arms from many of these other companies is really good. By the way, Valarm, who does the arms for gold back and for Kientz and all these companies, is doing this for countries around the world that are adopting it as legal tender. There's a series, if you go to valarm.com, of legal tender bills for other countries. So this is available around the world and affordable to people, and some countries are using it as a second currency. By the way, many countries in the world have a second currency. In Panama, they have the Balboa, which they print a little bit, but it's not inflationary because there's no central bank to just print enough to circulate, but really they rely on the dollar and competing currencies. And then we're talking about moving, gold in there as well, and the banks are open to that. So, a lot of people have more than one currency. In any case, so lots of different options for you. People can email me. I will tell you what I do. I'm not a financial advisor. I will not financial advise you. I don't want money. But what I'll do is I'll tell you what I do, and then I'll give you a bunch of stuff where you can go research yourself, and I'll tell you to go do your research, which you need to do. Don't trust anything anyone ever says on social media without checking it first. But I think it's pretty clear trends in history where this is going. And yes, you do still have time, and yes, there are options no matter your budget. And those are things that we can help people with, or we can point people. First of all, stay on your channel, obviously. But there are tons of places that people can get information on that. So
The accelerating physical gold flows, the rapid expansion of vault infrastructure, and the emergence of alternative trading hubs outside traditional Western financial systems suggest that gold is being redefined. No longer viewed solely as a defensive hedge, bullion is increasingly being positioned as a core strategic asset. Institutional accumulation isn't reacting to short-term volatility. It's laying the foundation for a future financial framework that prioritizes tangible, trust-based value. If current trends continue, we may be witnessing the early stages of a profound shift, gold evolving from a passive reserve to an active anchor in global trade and settlement. As parallel financial systems mature, particularly those fostered by BRICS nations, the precious metal could become integral to a new, multipolar monetary order. The question is no longer whether gold will play a larger role, but how far that role will extend in shaping the next era of international finance. Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.